By consolidating, let's say 7-8 companies, you can pretty much get a hike in your valuation. So you were like maybe a 3x or a 4x valuation, and then all of a sudden you go to an 8x or a 10x valuation just because you got a few companies together. That first thing when you acquire a company, forget about everything else. Revenue ring fencing. It is the number one thing. People think it's synergies. No, it's not. Look at how many people in the history of business have been able to scale their company from zero to more than 100 billion. There are only 4 people. Majority of them, I would say 999 out of 1,000, would not even cross 20, 30 million.
Good day and welcome to the Wealthy Entrepreneur Podcast. I'm your host, Bob Gauvreau. It is a pleasure to have you with me here today. I want to remind you that the Wealthy Entrepreneur Podcast is the place where we dissect the elements that contribute to your entrepreneurial success, from mindset and leadership to profits and revenue. And I'm delighted today to have a guest, an experienced M&A expert who's written multiple books on the subject. And we're going to make sure that you have access to those books as well as we go. But my guest today, his name is Anirvan. He's the CEO and founder of Fifth Chrome, a global business strategy advisory firm helping founders, CEOs, and investors build scalable and resilient organizations. Today, we're going to dive into the topic that many scaling entrepreneurs eventually face: how to grow through acquisitions and to build a scalable organization through a buy and build strategy. And you may be asking, what is a buy and build strategy? We are going to kick the podcast off with walking through that, but the opportunity that's involved with growing and scaling a business, you have to consider acquisitions as one form of a growth strategy if you truly are looking to build a business that you're going to be able to exit from and to build a business that has value, and to do so at a pace that is maybe a little bit more prompt than doing it organically. So really excited to have him in here today. He's a strategic advisor. He supports leaders navigating growth, complexity, and transition, particularly in organizations moving from entrepreneurial momentum to institutional scale. And his work sits at the intersection of strategy, leadership, and operating design, helping decision makers bring clarity, coherence, and discipline to how businesses evolve. I'm really excited to share this conversation with you guys today. I know it's going to be extremely valuable. So it's going to be all things M&A and things that you wouldn't necessarily consider and things that we haven't necessarily talked about on this podcast before. So I look forward to sharing this with you. And you know what? It's time. Let's just bring him in. Anirvan, it is a pleasure to have you on the Wealthy Entrepreneur Podcast today. And to kick things off, maybe just tell us a little bit about how you got started in your career and how it's evolved to where you are today.
Sure. Thanks, Bob. And I'm excited to be part of this conversation today. Starting out, let me kind of paint a bit of a picture of what happened. So essentially, I was born and I grew up in India, in Delhi. And over there, it was already, because my ancestors come from east of India. So it was a second culture where I grew up. And then I started my first job as a salesperson. I used to sell Dell machines, even though I had done engineering as my bachelor's degree. So it was a complete contrast. And then from there moved into sort of solution design, into software coding for a number of years, before I realized that the people who call the shots sit at a different room compared to the software developers, right? So, which is what got me started in that lifelong quest on how organizations run. And early on, I'd recognized something called pattern recognition. This was a subject I would have probably pursued and done masters, but things didn't happen the way I wanted it. But that pattern recognition is something that continued throughout my life. So I have worked so far, I've worked in my career, as in a corporate career, more than 20 odd companies in different shapes and forms. And then in my consulting business, I've worked and trained folks in more than 100 companies, 100 different industries, 80 plus countries, right? So this gave me a wide array of how things are similar and yet not similar. And by the way, I started my M&A career back in 1997. Literally, I joined GE Capital. And the second week I was there in Amsterdam, I'm based in Amsterdam. I'd moved from Singapore. We were thrown in the deep end of the pool. We were like, hey, we've got a company that we need to now integrate. I don't think somebody said integrate, but we just acquired a company and we need to make the systems work together, right? So I didn't even know the integration existed as a word back then. And since then, I've been involved in lots of different transactions. But what started out in 2013, which is when I left my GE career, was my quest of trying to understand what happens in the boardrooms, what happens in the pre-deal stage, in the acquisition stage. And that's where I ended up working very closely with strategic investors, family offices, PEs, as well as companies that were going through both from buyer's perspective as well as seller's perspective. And because I helped a company to be set up as a PE, it also gave me an understanding of the VC route into PE kind of thing, right? So it gave me a wide array of understanding what that is. So on the basis of that, that's kind of what formulated on what I have now been producing over the last 5, 6 years. So what has happened is in the past, it was all about learning, 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 learning. And there came a point in time, it's like, you know what? I've done enough of learning. Not that we ever stop learning, but it's like now it's also for me to give back to the world, right? So this is where my training started. And then I started writing books. Literally the last week, my 10th book came out. So the last three, essentially a trilogy on buy and build. So that's a long, short answer for my origin story.
No, I love that. So talk to me a little bit about what buy and build is, because, when we think of M&A, obviously, it's highly exciting. It's a little bit scary for a lot of people. It's a really great growth strategy. So talk to me and maybe describe for everybody what buy and build would be according to your terms.
Sure. So buy and build essentially, in my opinion, has three flavors. So the flavor one is where an individual entrepreneur, that person goes and buys a company. It could be 500,000, 1 million, whatever it is, small company, and then build it, right? We're not talking about that buy and build. Okay. The second one is what's pursued by Fortune 500. So for example, let's say a large company, they decide, without naming names, it could be anybody, GE, Amazon, Apple, whosoever, they decide that they want to do something specific. And, it could be a new product in the market. It could be, let's say, a new operating model, whatever it is. So they decide that that's strategically where they want to invest further, right? So this was something, for example, back in my days at GE decided to expand into water management. That's where GE acquired a platform company and then did subsequent acquisitions and then kind of build the portfolio into a buy and build story. Now, that buy and build is also different from the third buy and build that I'm going to just speak about. The second buy and build essentially is you buy, but everything becomes GE, let's say from that example. So the core let's say the core pieces, whether it's culture, whether it's the way people used to work, the operating model, that changes massively. Okay. The buy and build, which is the third category that I'm talking about, which is what you alluded to, is it's a fantastic way to grow rapidly. And this is essentially very prolific in the sub 250 quarter of $1 billion kind of a scenario. And one of the main reasons why a lot of companies these days pursue buy and build, because it's easy, as in it's overnight growth. Second thing is there's a lot of money available in the market in terms of private equities or institutional investors or others who are ready to lend money, family offices. The third thing is, which is what's in it for the PEs or the VCs, is the upside. So which means that by consolidating, let's say 7, 8 companies, you can pretty much get hike in your valuation. So you were like maybe a 3x or a 4x valuation, and then all of a sudden you go to an 8x or a 10x valuation just because you got a few companies together. So that is where we talk about buy and build. So buy and build essentially in a nutshell is you acquire a company, portfolio company, and then you acquire a few more, and you essentially start building this company up. And that's your buy and build in a nutshell.
Yeah, 100%. And you know what? All of those would maybe be an area where we've done that in the past as well, right? We've looked at specifically areas of our business where we want to expand maybe a product line or a service line, acquire an entity that has a little bit more experience, a little bit more resources, and then we bring that into the overall entity. But for sure, the idea of, is it called arbitrage? Is that what that's called? Where essentially when you make an acquisition that your multiple goes up because you've then just brought it into the next sort of EBITDA. I think that's what they refer to it as. But yeah, super, super valuable. So when would a business owner really start thinking about when a buy and build strategy would make sense for them? Like, I'm
Sure.
guessing it's not day one, or could it be day one as well?
Yeah. So there are people these days who essentially, the moment they come up with an idea, they think it's going to be a buy and build. Okay. But it's not as simple as that. So what we have done, and that's in my trilogy book that's on buy and build operating system, is a good point for a company to be part of buy and build, not necessarily to be the buyer, but to be part of buy and build, starts about 5 million. So we've done the stages, 5 stages we've defined for the buy and build. So first stage is 5 and 15 million, which is primarily a founder-driven company. Then you have 15 to 30 million, which is when you start setting up kind of doing platform setting, some of the fundamentals. 30 to 60 is when you start doing proper acquisitions. You start that, and then 60 to 120 is what we call institutional. And then 120 to 250 is essentially you start becoming like a conglomerate, kind of trajectory that you start. Now, you can buy a company even when it's 500,000, okay? But the uncertainties are huge. There's something called product market fit. Typically, when a company gets a product market fit, it usually has crossed the threshold of 5 million. We have taken revenue numbers because that's the best marker we could get. Because if you go by the number of people, it can be skewed. There is some variation with respect to industry or with respect to the location, but largely the revenue markers are pretty good sort of markers indication. So we say for the companies who want to acquire, they should be about 60, 70 million, definitely more than 30, 40 million. The companies which I would say are ready to be acquired, 5 million would be a good starting point.
Okay. And so, thinking of acquisitions, and this is maybe a strange question, and you might say, well, Bob, it really depends. But when you're looking at acquiring a company, let's say you've got an existing business in place, do you feel like the strategy should be that you're buying smaller companies, companies that are of similar size or even larger? Like, I'm assuming all of those have different risk profiles attached to it. Which one do you see the most success with?
It all depends. So normally, you would see the companies that get acquired are 5 to 20 times smaller than you. There are plenty of cases where the company that got acquired is larger than yourself. And we call it the reverse mergers because they probably have more sophisticated systems. The leadership is probably better experienced or have certain advantages over you. So we call it a reverse merger. Now, in reverse merger, again, 70% of the mergers and acquisitions fail. For whatever reason, it fails. And when we say it fails, it means the value that we were supposed to generate from the transaction did not happen, or it got eroded very, very quickly. So reverse mergers do take place, but it's a lot more complex. And one of the main reasons is when you are an acquirer, you tend to be the big guy at the table. Even if the company across the table is bigger than you, but you behave that I'm the boss. Okay, it's human nature. The person who's got the money tends to call the shot. So examples, I've seen a couple of very good examples. Now, the reason why they went and were successful, I would probably attribute it to the backing of the PE, because the PE guys knew they had been through this. They had people who could mentor the executives of the acquiring company as well as the target. But it was the PE that made that difference, PE and probably the operating partner.
Absolutely. And so when you look at some of the 70% failure rate, because that is a staggering number, but that doesn't necessarily mean they're a complete failure, right? It's just that they didn't necessarily accomplish what they were set out and intending to. From my understanding, one of the greatest challenges is in the post-integration role, right? Why is it that that is the area that causes the greatest challenge for the success of an acquisition?
The same reason why technology is always pushed into the basement, technology teams, right? um, it's not glamorous.
Fair,
Yeah.
right? Signing the deal and giving the dollars and everything, that's the exciting part. But then
Yeah,
the work
because
really starts.
correct, because there is so much of secrecy, so much of money being talked about, and nobody talks about less than 5 million, right? That's the nature of the game, Even some of the rewards that your brokers, your bankers, your lawyers may get, on success, is still a large fee. It's a large check. Compared to, let's say, for integration, it's like, oh, you know what? How difficult can it be? Let me hand it over to the HR guy. Let them figure out, or let me give it to the technology guy. So there is less of recognition that integration is where the real value creation happens. Integration is messy. Integration is tactical. Integration is also functional. And therefore, CEO does not want to be involved in the day-to-day what happens. So it's the nature where the attention, the focus gets lost. The first thing that happens is erosion of revenues. So the target company, some key people may have left the company because they're part of the seller group. So there are people who leave, good sales guys leave. So there is usually a downward trend on revenue. And that's what we always advise, that first thing when you acquire a company, forget about everything else. Revenue ring fencing. It is the number one thing. People think it's synergies. No, it's not. It's a revenue ring fencing. Everything else should be subordinated to that. Because if you don't have revenue, you can keep crying till the cows come home, but without revenue, the companies don't exist.
And so why would you say, and I've seen this, and truthfully in my acquisitions as well, we've had some turnover that happens right out of the gates, right? And, in the past, I've had my COO sort of have to, I take it very personal,
Sure.
right? When you have somebody depart, you're like, what is it that I could have done better?
Yeah.
And, he sort of talked about the rates and the expectations of the fact that it is a drastic change and some people are just ready for it and this is a trigger moment. What do you see as, some of the reasons why people leave, or what are some of the reasons or strategies that companies that are making an acquisition could put in place to eliminate or reduce anyone leaving?
So the first one, and which is what I've also mentioned in the book, see, if you are working in a company that's, let's say, 10 or 15 million, I'm just doing some comparisons, versus a company that is acquiring you, that's 120, right? So the 10 or 15 million is essentially where you could wear a t-shirt, go to work, everybody knows you, you guys work long hours if required, have pizzas, kind of thing. The 120 million on the other side is you probably have, kind of a suited meetings, board meetings, kind of thing. It's a lot more management by number, a lot more structured. You probably get into some sort of an annual appraisal mechanism or tactics that needs to be done. You'll be given goals, etc. None of that is there in that 10 to 15 million, right? And the first thing I tell CEOs is that let's call that person Alex. I said, Alex, keep in mind, I know that you want to grow your company, but look at how many people in the history of business have been able to scale their company from zero to more than 100 billion. There are only 4 people. Majority of them, I would say 999 out of 1,000, would not even cross 20, 30 million. Okay. And I said the reason for that is not because they can't, but in my opinion, they should not, because it's not them. An entrepreneur is somebody who always loves to get new ideas. Okay. It's the next thing that glitzy that I want to pursue. Because you'll constantly try to keep your mind fresh, and look at least explore opportunities. Somebody who's like a CEO at 100 million, 120 million is thinking, how do I do my capital allocation? Behind which product, what sort of money should I put? Okay. Very different. And I say, if look at it this way, do you really want to be that kind of a person? Some people say, yes, I would like to be. I said, in that case, absolutely, you should pursue. But if not, then keep in mind that in 1.5, maybe 2 years, you need to hand the baton over to somebody else. Okay. So this setting of stage right up front has actually yielded a lot of positive results, because compared to that, everybody's like, oh, you don't tell the CEO, or don't tell these execs that this is how it's going to happen. And that's where there is distrust. People are not transparent with each other, and mismatch of expectations.
Absolutely. One of the challenges that we've had, and we've got there, it just, for some reason, seems to take a little bit longer. How do you, or what's your guidance and advice on creating an entity that has one culture going forward?
That's a misnomer. One culture is a misnomer, right? I'm just saying it out of the gate for a couple of reasons, right? First is culture. It means it's the way we do things here. Okay.
Yeah.
Everybody has their own version of how we do things here. Okay. In my book called Promise, I have described culture as a tree where values is right at the top, and the leaves and the branches are the beliefs and behaviors. The trunk of the tree is your leadership team. And then you've got these 4 things which are under the ground, right? That's your structures, your practices, your rituals, and your artifacts. If you want for your tree to grow, what you do, you don't add more leaves, you don't add more branches, you put water, you keep fertilizers, whatever it is, everything is below the ground. It's the structures, you put in more structures, you change the practices. For example, if you want to become an innovative company, you start changing the practices, saying, okay, this is what we need to do. You change the artifacts. The artifacts essentially would be you paint the colors, you paint the color of the wall as red or pink or whatever, right? You get bean bags in the office. That's artifacts. The rituals is you have Friday evening drinks, So for example, if you need to change the culture of an organization, you need to start at one of these 4 underlying buckets, because this is what reinforces. Now, culture. The first culture of an organization is formed as a reflection of the founder. A is the founder. Subsequently, when the company grows up, it usually tends to largely follow the CEOs till you are about 70, $80 million revenue. After that, you start getting institutional cultures. Institutional cultures essentially means there's no longer one homogeneous culture, but several microcultures that kind of blend in together to become one large culture.
It's interesting because you're right. With the core values that we have, a lot of it is more of, we sort of created it based around the behaviors that we didn't want and reinforcing the behaviors that we did want. And truthfully, to attract the people that we felt would best support those behaviors and avoid those negative behaviors. So yeah, it is fascinating. And to think of the institutional sort of level as well, like our business, we're just about $25 million in revenue. And so every time you start talking about levels, I'm putting us in there. And everything that you said has been pretty much bang on in where we would fall into this. So fascinating. I love this discussion as well. If you're thinking of a business owner who's getting ready for an acquisition, what financial and operational disciplines should be in place before they even think about making an acquisition of another business?
So first thing is, I say in my stages, the best time for you to start acquiring is roughly about where you guys are, 25, 30 to 60 is the best time to start acquiring. Anything that you may have acquired prior to that, your company was not ready. It's not the other company. Your company was ready. Why? Because you have so much of fractional workforce that anything that you put on them, it can break your backbone. The fragility is so high. So, for example, one of the companies, I was mentoring the group guys, the group investors. One of the companies that they pulled me in when we started putting the operating rigors in place, some of those guys said, no, we won't do the operating rigors. I'm like, okay, because we tried to put in some discipline. And the company was so fragile, three of the people left because they didn't want to follow a routine, and I'm like, I understand, because they probably were still in the 1 or 2 billion thinking, even though the company was already more than
Yep.
15, so they just didn't want that sort of, they wanted to be the heroes. They wanted to be the cowboys or cowgirls. Back to your question, what is important is, we call it the stage 2 platform setting, meaning your company should be ready as a platform, meaning you need to have certain SOPs, you need to have certain processes, certain systems in place to be able to go out and acquire. Now, another thing that you need to keep in mind, which is what we call the inner circle of a CEO, is that the CEO also need to start developing relationships in the external market. Meaning you need to, know potential targets or the kind of companies that you want to go after. At least you should know one or two of them, because that will open up your thinking. Saying, if I were to acquire, let's say John's corner shop, okay, I've known John for whatever number of years. I know how he operates. So these are the things that I need to think, to bring in. The other group of people you need to absolutely speak to would be your bankers. Hopefully, you're banking with a decent enough bank that they have an M&A wing, because the bankers know whether you're ready or not. The bankers also will be able to say, yes, we can offer you some sort of a debt financing or whatever. These are the first guys who can tell you financially if you're in a position to acquire, or what are the instruments you may need to use in acquisition. The third is the group of, let's say, others, people, consultants, lawyers, all that. Okay. Then you need education on M&A, because what most people don't realize is, if you're buying a company that's worth 10 million revenue, but only, let's say, 500,000 profitability, then it does not mean that you need to spend 10 million to buy the company. Okay.
Yeah.
It's multiples of, not only that, it's not 100% day one cash. In fact, I've known multiple companies that the day one cash was zero. It was all sellers advance, or or it was through earnouts that it was played. In fact, there's a guy called Jay Abraham. I'm sure you know.
I do know Jay. Yep.
Yeah. So his book, and he wrote this book with another guy who has a podcast. I'll give you the name later. So essentially, they wrote a book. It came out last year, where they talk about how do you buy a business without spending a single dime on day one. So
Yeah.
yeah. So yes, so that's what I would say. In order to get ready, this is what they should. And practically, I mean, I've spoken about them in my book. There's also another guy called John Warlow. He's written a book called Built to Scale.
Yep.
Or build to sell, not build to scale, build to sell. His value framework, 8 elements, are also a good framework to kind of measure your company against.
So John Warlow has a company called Value Builder
Yes.
and has a certification process. So years ago, I did his certification
Oh, you
process
did?
as well, which is, yeah. So we're very familiar about those 8 factors, and
Right.
that truthfully, like, an important exercise to go through and make sure that your company is ready to sell, because I think some of his statistics would share that 70+% of businesses never sell, even though business owners think that they will. And that's
Right.
part of their retirement plan. So
Correct.
yeah,
And
great
I
book
use
and
the same
great system.
principle. I use the same principle for buyer readiness. Imagine if the seller has got all of those 8 boxes ready and the buyer's got only 4,
Right.
it's going to
Yeah.
struggle. So
100%.
yeah.
So as someone who's looking at making acquisitions, right, as a business owner who's thinking about that, why should we as a business be thinking about this, not just as growth, but also as a wealth building? And I think we alluded to this earlier, but a wealth building and an exit strategy. Why should we think of it that way?
Let's say your company is 25 million, and assuming that, let's say, you got 2.5 million as your profitability, at 10%. I'm not saying good, bad. I'm just saying 10%, right? So if somebody were to come in and buy your company at this point in time, because usually it's a 15% mark where they say, oh, you know what, this company is pretty decent, versus 10% is like, okay. So you're likely to get like maybe a 4x, maybe a 5x on the valuation. If you are operating in a market which is highly competitive, then obviously you can go up to 6x. But usually it's about 4x, maybe 5x in some cases. You go through an acquisition process, you're 25 million, and let's say over the next 3 years, 2 to 3 years, you acquire another 4 companies, and your total goes beyond 100 million revenue number. And let's say you're still operating at a 10%, which is 10 million. At that point in time, your valuation is going to be 8x, not a 4x or a 5x, but 8x, right? So all of a sudden, that company could be sold for 80 million. So that is where the real wealth creation can happen for people who are looking at 3 to 4 years, acquire some companies. If you are able to merge and create a better quality EBITDA, for example, if you start going into, let's say, 20, 25, 30%, then you start crossing into 10, 12x. If you're in the technology space, you can go up to 18x. That is where the wealth creation is.
And again, we chatted about this earlier, but as you make acquisitions and you're growing, your multiples and your valuation will go up. So you'd sort of alluded there at the end, even merging of 2 larger entities, bringing in 2 entities that are maybe 8x already and then bringing them together and they sell for 12x, nothing really changes from a seller side aside from the extreme valuation increase as an exit strategy. So very powerful, right? And it's important that people are aware of this because a lot of people don't know, and they're happy with 3 or 4x EBITDA numbers on an exit, but they just don't realize that if they just did a little bit different strategy on this, that they could really elevate that. So very, very powerful.
So one more aspect to the wealth creation is the CEO's personal wealth creation, right? Because typically what happens is, I'm sure like you're running a $25 million company, the amount of time that you need to invest in a business must be mind-boggling. It still is. Okay. It starts changing when you start inching towards becoming an institution. You may not be spending as much time that was required to be in the business. You're spending more time on the business and around and relationships and external relationships. That itself creates further avenue for you to create wealth, meaning you're not pulled to the practical stuff, but you are able, it frees up more time. And I've seen so many CEOs who have actually crossed over to the other side. I'm like, Anirvan, now I have the team which is taking care of it. I don't have to get so involved in the tactical stuff and, hair pulling stuff any longer. So, and that's a huge, huge change.
For sure. And as businesses continue to grow, as they have increased profitability, they have the resources to spend to go bring in that CEO that maybe can take the company to the next level or has experience maybe leading through acquisitions and stuff like that. And it's funny because we had this reflection a few years ago. Organically, we sort of got our business to about 16 million. And, I had to do that reflection to say, am I the person that is going to be the one who should lead this next charge? Or am I not? Right. And it is challenging. And I spent about a year reflecting on that and really learning and investing in books and in leadership training and in coaching and in everything, and ultimately decided, whether I'm the person or not, I'm all in to do this and to make this happen. And we'll see when that next conversation comes up, but it sounds like it would be when we get to that institutional type level.
I always say, like, for dynamic entrepreneurs, and who love trying out new stuff. It's like being one of the 4 people to cross 100 billion. It's like buying a lottery ticket and winning it, right? So, but let's say for most of the people, I say take it to the institutional stage. And what will happen is there's a few things that are going to change. First is your organization is going to become a lot more institutionalized, a lot more following a certain operating model, certain structure. That's one. Second thing is, during this period of time, you would be developing this sixth sense of capital management and capital allocation. Where to put in money, behind what? Is it transformation? Is it market growth? Where am I going to put in money? Because that's a muscle that you probably did not have in the past. That's a muscle that you'll develop as you have chunks of money available to you. The third is because of the external relationships and because of the capital understanding and the understanding of the industry, I've seen several CEOs take on a chairman kind of a position or a chairperson kind of a position, which works out to be fantastic because they're still reaping the benefit. The company is still growing. They've made their money, and yet they're not out of job.
Yeah, and I could definitely see that, as someone who's continuing to invest in growth myself, I could see that as the evolution, right? It's the evolve into, sitting on the board, being the chair, hiring the president to run the day-to-day and, moving into more creative and strategic, but not as required on a day-to-day basis, or making the company not as reliant on yourself. I think we as entrepreneurs need to be thinking of it that way. We need to think of what that next phase could look like, because it could be here before we know, and we got to be prepared.
100%. Or even better, be intentional about it. There's nothing wrong in creating wealth.
Exactly. Although some people put shame behind that, or it's like, no, absolutely not. This is what we're here to do. And especially us, like as a CPA firm, we continue to focus on making sure people are structured that way and they have the information they need to make the right decisions. So yeah, I couldn't agree with you more. I have some rapid fire questions here for you, sir, if you're ready for them. Okay, here we go. First question: organic or acquisition-led growth? Which one's better?
When you say better, it's always simpler to do acquisition-led growth. It gives you overnight revenue. It can get you to a higher multiple on valuation. Organic is tough, but organic is also long-term.
What is the biggest mistake you see founders make in their first acquisition?
They think that acquisition was as simple, or integration is as simple as acquisition.
Yeah, that's a tough one. That's a tough one, right? Yeah, where's your integration checklist? What integration checklist? Yeah. Super important that that's in place. What is the fastest way a CEO can destroy value after acquiring a company?
You don't ring fence the revenue, and you let some key people leave the organization. And if you delay having the right people in the right seats, the business is doomed.
What is one leadership habit that helps founders successfully transition from operator to a scalable organization?
They need to, in their minds, have a visual of what the good looks like, what the next stage looks like. Without having any experience, it becomes a much tougher job, and which is why the more successful CEOs that I've seen are the people who have actually worked on larger companies, and then they've come back, and then they're trying to sort of run it. So it's, I call a spade, and that's why I say that's one trait CEOs must explore and put some learning in place properly.
Okay, so we've referenced that you've written 10 books. Okay, and what we're going to do, we're going to put the links to all of your books in the show notes here and in the comments below, to make sure people have access to this. I have to know, and I understand that there could be bias related to your most recent release, but what is your favorite book that you've written so far?
I would say Promise, which was my fourth book, I think, or the fifth book, is the still my favorite. Why? Because it talks about strategy. It talks about, PROMIS is an acronym, and it starts from strategic thinking. That's the first one. The second one is innovation and critical thinking. So you start with the visualization, then you think critically. What do I need to change? You think innovation. What do I need to bring in? Then you think about organization structure and leadership. That's your O of the PROMIS. And then you talk about the management system, which you need to put in place. And then you have people and professional development. What talents do I need to build? What capabilities do I need to bring in? And then you have essentially, you have the I've already spoken about the people development experience of your employees. How would the employees be able to contribute to the value? And the last one is rewards and recognition. It's your levers to make sure that people are following the right way or versus not. So it's a very, unlike a canvas kind of a thing where you can drop on how, if I need to transform my business, how should I transform my business? So it still remains my favorite.
Okay. I will definitely make sure that I read through that one first. We will put all 10 of them in here. Thank you for your insights on that. Now, you referenced operating systems. Now, if you were to say, hey, this is my favorite operating system that I've seen, Bob, and I've seen the most people have success with that, what would that be?
When it comes to operating system, so essentially operating system is not a single dimension. It's got multiple dimensions. So one thing that we talk about in buy and build is called combine operating system. So combine is culture, one organization structure, one management system, one information and systems. B is one branding and marketing, and then one information systems, one number and financials, and one experience, right? So it means that these things need to hinge together. That forms an operating system. It's not the outside facing customers or the suppliers, but it's how you run your organization. And following combine as the backbone, it allows you to scale your company.
Excellent. I was kind of hoping that you're going to say something like the entrepreneurial operating system, but you're talking about the whole integration of all of the systems that make the operating system successful. Totally makes sense.
So the EOS traction is what kind of inspired me to create the combine. And the next one is what we call the buy and build operating system. It's based on 7 categories, 56 different dimensions. So, yeah.
And you know what's super valuable? So, and obviously Traction is one of the founders, I think Scalable by Vern Harnish or Scaling Up by Vern Harnish. Like there's a bunch of, maybe some of the founding structures that are out there related to operating systems. But I think there's so much value in people understanding the different iterations that are available out there. And so like that, I'm fascinated to check that out from you as well, because, we sort of implemented one and we've kind of got hybrid versions of different makeshift systems all around. So, but for everybody listening, like always be open to insights. Like I'm sure you have great insights in yours that I would want to incorporate and go, that's a missing piece. Right? That's a missing piece. So love that. Look forward to checking that out. You also have a podcast. Tell me about your podcast.
Yeah. So, to be honest, I started my podcast a good few years back. When I say it's still during the COVID time, we've done till 5 seasons. And last year we took a bit of a sabbatical, and then now we're coming back. So this time we're going to do it on buy and builds. It's called Fifth Chrome Business Insights.
Okay, great. So we will make sure again to include the link to that below, so anybody can check that out. Obviously, Anirvan, you've got so much insights and wisdom to share. For sure, I will be checking that out as well. Last question for you.
Yeah, and just before we go there, on reflecting on your previous question or the previous part, EOS, Warren Harnish's Scaling Up, these are excellent framework for you to get to about, let's say, 4 or 5 million. So that's where, and I've used their thinking, the understanding, and that's where they leave, and our let's say our buy and build operating system takes over, because every stage is different. And people need to recognize this, business owners need to recognize this, that now I'm no longer suitable for my garage office. I need to
Yep.
get a downtown office, and then I need to get a city office, etc. So it's all about stages.
And so did you write a book specific to your operating system as well?
Yeah, so it's the buy and build operating system. That's the
Okay.
trilogy. Yeah,
Okay.
which talks about the 5 stages. Yeah.
Okay, excellent. Well, I will definitely get my hands on that. So we talked about your podcast. Last
Yeah.
question I have for you, which is one of my favorite sort of pieces, which is, you've got a lot of experience, you've had a lot of success. You bring a lot of wisdom to the market, and so I think it might be even more powerful for you than most. But if you had to go back and give yourself one piece of advice when you were starting, what would that advice be?
When I was starting, if I were to reflect back, I would say the need to have a mentor or a series of mentors. That's something that I realized much later in my life. I wish somebody had told me right up front, saying, Anirvan, you need to have somebody who can mentor you, not your dad, not your elder brother, not your friend, but somebody who comes from the business background who can tell you what to do versus what not to do. So having a mentor, having a guide is something I absolutely sort of say that that's probably the thing that I would tell my younger self.
Absolutely. And keep investing in yourself, right? Like for anyone, keep investing in yourself, and younger, older, we always need to continue to grow and learn. And I think there's a lot of people that need to check themselves at the door who think that they have the answers to everything. And, I try and intentionally approach it the opposite way, to say, I have so much to learn from so many people, including yourself, right? Who have an expertise and a wisdom in something that I haven't experienced. Like, I want to be a sponge. And, to follow up on your comment, be a sponge, be a sponge and take that information in and continue to learn. I would say it's the key to a long-standing entrepreneurial journey of success.
A key to being a successful business person, a key to a super successful executive in a business. It's that sponge. It's like, Bill Gates spends every year, he takes those 10 books or whatever, he goes into this. So it is perpetual learning. There's no second guessing around that. Yeah.
Anirvan, this has been an absolute pleasure, my friend. Thank you so much for joining us today.
Thank you so much, Robert. I seriously enjoyed it, and I wish we had more time, but then podcasts
I
are
know.
supposed to be limited. Yeah.
Hey, you know what? There's no rule that says we can't do it again, and that would be a lot of fun. But thank you so much for this. Guys, the insights that he shared today, if you're ever looking at, and even if you haven't been looking at an acquisition or thinking that it's maybe something that doesn't fit, now you've got a whole new set of tools in your toolbox to understand where this could apply. So, thank you everybody for joining us today. Anirvan, again, so many great insights, and happy to make sure that everybody knows how to contact you. We'll make sure that we put all that information in there. Guys, this is the Wealthy Entrepreneur Podcast. I'm your host, Bob Gauvreau. It's a pleasure to have you here every single week. And you know what? We're here to empower entrepreneurs with the financial confidence to make informed decisions, to grow, to scale, to find those right opportunities. And so if you found this valuable, please leave a comment in there. Give us a like. Make sure you give us a follow. We want to make sure we bring you new insights next week as well. But even more importantly, if there's been something you've heard here today that you think, you know what, I need to share this with someone that I know, or share this out to my community, please grab this, share this. We're here to empower all entrepreneurs to find a level of success so that together we can make a positive change in the world. Guys, it's been so much fun here today. I look forward to seeing you again next week.